a real player, they are willing to risk their whole stack when it kind of becomes necessary because they know they're not playing from anxiety.
I want to point at one or two extra things that are really important. Like, you can go and listen to other podcasts and read other analysts and look at like the Motley Fool and Seven Investing and services like this. But the most value you will get is from going to primary sources.
You're already in. If that all blows up, you've lost basically nothing, but you've taken the most important first step.
Buying properties is not like buying bananas. Like, they're not a commodity. Every property is unique and different.
For an advertising-free version of the show, check out patreon.com/Wall Street Wildlife.
Welcome to the Deep Investing Jungle with your hosts, Luke the Badger Hallard and Christoph the Monkey Piekarski, where we separate the signal from the noise in the wild world of investing. This week, the importance of valuation and why you probably shouldn't have more than half your portfolio in Palantir. We also revisit an old favourite question that just came in from a new Patreon: how to get started as an investor. IREN energy is taking off. Is this the next rocket lab? Monkey talks about a paradigm shift hiding in plain sight. Plus, I'm going to give him a proper badgering over his new investment in Open Door. Looking forward to seeing him squirm as he tries to defend this misguided investment.
Yes, Badger, but to late breaking news. This is a contest that Badger and I started back in early November of 23. Badger, can you describe what you see on this chart for those who are not watching us on YouTube and are not seeing our handsome furry faces?
You can see the trajectory of our holdings in the King of the Jungle Challenge since we started way back with like $1,000, and now we're nearly at $8,000 each. Well, the yellow banana monkey line has been lagging pretty heavily, and at the end of our first year, monkey was underwater where the badger had made decent returns, so they were diverging quite nicely. That grey badger was stretching away, and you nearly caught me up in early 2025. Like, our lines nearly inflected, but not quite. And then your portfolio fell into the cesspit again. But what's happened? Like, in the last 3 weeks, you're in the lead. You've taken the lead. You are the new king of the jungle.
Badger, you see this mug that
I
I'm
see this
drinking
one.
my coffee today? This is the Team Badger mug. And you want to know why I'm drinking coffee from my Team Badger mug? Because everybody loves a good underdog. Everybody loves to root for the underdog.
Are there really any underdogs in this contest? Like, you have redeemed yourself, and you've exceeded my returns. Good job. Like, you're gonna have an incredible return for this year, clearly, because you've made such a massive comeback. I didn't think you could do it, if I'm quite honest. I'm surprised. And later in this episode, you're going to tell us about one of the stocks that got you there, but there's a whole bunch of your investments that have come good. Um, but there are no losers here, right? I was saying that all the time when I was in the lead. Like, we're both beating the market by a nice margin, and that's our objective.
Yeah, so man, I have a couple of things to say. One, to flesh out the story, at the point, maybe late 24, I believe you were having a little bit of despair when looking at this contest because you're like, oh my God, my co host is going to embarrass us. And then I'm just going to exponentially, widen my lead. And it's just going to be a walk of shame every episode. And that can't be good for the numbers. So I'm glad. I'm glad that for now, we reconverged. That's one. Point two, I rarely say this, and I hope this is the only time I will have to say this, but I am deeply disappointed in our Patreon crew. So over on patreon.com/Wall Street Wildlife, we have three channels: the Jungle Lounge, where we talk all kinds of investing stuff. We have our trade channel, which is where you and I, whenever we make a trade, we tell you what we did and our logic behind it. So you could do your own research in whether you want to follow us in that trade or not. And then recently we opened up the watering hole where we could just kind of shoot the shit about, non-investing topics, what got us, what we do. And it's really sweet, actually, for those of you who haven't checked it out. It's a really sweet channel, and it serves a function: building community trust, and we become better investors together. Here's why I'm disappointed in our crew. 2 weeks It was 2 weeks ago. It was actually before IREN took off. After the latest announcements, Monkey had taken the lead in the King of the Jungle challenge. But not wanting to be a gorilla pounding my chest, all that Monkey did was posted a link to a Bob Dylan song called "Changing of the Guard," and not one of our jungle critters picked up on that Easter egg and connected the dots between the newest King of the Jungle and the Changing of the Guard. But now it's out in the open, so to the rest of you, pay more attention.
You have posted like a succession of strange videos and music videos. So I thought you're just losing your mind as usual. Okay. Didn't realize an Easter egg. Deep cut there. Excellent.
Yeah. I mean, not to be not to be overly insulting, it did lead to a great conversation about all the Bob Dylan fans we have, and what a great song that is. But that was intended to point to the King of the Jungle portfolio. One last thing. We say this. We've said this a bunch. We started this at $1,000. We're now close to $8,000 each. We're modeling consistency. All we're doing is adding $100 per month or $200 per month these last 9 months. And when you look at this line, that whole compounding thing happens, and before you know it, I mean, it's from 1,000 to 8,000, the numbers start
Yeah.
getting bigger and bigger, right? That's how you did it, right? That's how you did what you're known for. When it gets to the what's it called, 5 digits, some people might start feeling intimidated. Oh shit, I don't have $10,000. This is why looking at this graph is important. You don't need $10,000. What you need is what you have right now, and you just got to get started and do it consistently. End of my gospel.
No, that's right. And like the journey, like we've been doing this for over 20 years, and but I've really focused on like it's like my investment portfolio now literally supports my lifestyle. Like it pays me per month way more than my job ever did by an order of magnitude. And when the numbers, we got like high 4 digit portfolios, and as you say, like we're going to get to like a 5 figure portfolio in the King of the Jungle soon, and that's our returns there. Like our investment returns are important, but the money we add is probably the bigger thing. Like we're adding new money. Once you get to like a mid 5 figure portfolio, our investment returns are going to be much more meaningful than like the $200 we're adding each month. Maybe we'll increase that. I don't know. We'll kind of make that decision as we go along. And once you get to like a 6 figure portfolio, like into a 7 figure portfolio, like there's almost no point in adding new money unless you're super wealthy, because you can't add meaningful new money. It's all about making good decisions and having compounding working on your side. But if you're getting the kind of returns, well, let's say I'm getting, like I'm beating the market by a substantial margin in my real money portfolio, 22% CAGR. So that means my portfolio like 10x's in value every 10 or so years. So like the journey from 100,000 to a million is going to take the same as the journey from a million to 10 million is going to take the same as the journey from 10 million to 100 million, right? The numbers become truly eye-watering. You just need to keep doing the same thing. Like learn your lessons now when you're like a younger investor and the money's small, and make your mistakes because they'll cost you a couple of $1,000, not like a couple of $1,000,000. And just get going and start learning the lessons, because these lessons will repay you. And one day soon, before you know it, you'll be looking back and you'll have like a large amount of money.
Yeah, and you know what, Badger? As you're saying that, I noticed one more, I think, obvious lesson when you look at my line, the yellow one, the monkey line, it has had severe drops. That's how, in some points, your lead was quite sizable. I would venture to say that most inexperienced investors who have not done what we've done for so long, when that line drops so much, they get discouraged. They say, "Fuck this! This is not, this is this. I just can't stomach losing that much money. There's no way I could win. Whatever." What did I do instead? Nothing but continue to add money each month and work hard, study, and figure where to allocate it, have these conversations with you to justify my thinking, and letting time play out the story. So it's important not to get discouraged no matter what's happening. And obviously when things are going well, you want to you want to notice that, oh shit, now everyone thinks they're a stock market genius. Things are probably going to turn the other way, so let's prepare for that, and then you steady the ship.
That's the bit I'm kind of looking forward to in a masochistic way, because like we're in a growth cycle, and depending on who you listen to, this is going to carry on forever because of AI and all the things, or like everything is wildly overvalued and the market's going to turn and everyone's going to get caught with their pants down. Like whether that comes tomorrow or it comes in 10 years' time, at some point this growth run will stop. And the valuations of companies like Palantir, we're going to talk about that today, will be significantly down from where they are. The good companies and the bad companies. And like our graphics in the King of the Jungle, they're going to turn south and we're going to get, like an ugly period. And that's when the value of having like podcast buddies and being part of a community of like-minded investors that are really thinking hard about the thesis and what they own. They're not just looking at charts and stock prices. That's when the value of this stuff comes in. Like, hopefully you're enjoying the Wall Street Wildlife podcast now and everyone's kind of winning together. But it's when things get bad that this podcast is going to be really value add for you. So, like, if you're not a subscriber, click that subscribe button in preparation for when the ass falls out of the market, because it's going to happen.
Yeah, for sure. And say hello on our Patreon channel, because that's where you make the alliances, and then you won't feel so alone, and then you'll hang in there, and you'll make yourself thousands or tens of thousands of dollars by that simple move. All right.
Right.
Badger, you threatened me on our Patreon channel, on our trades channel, when I announced that I bought a small position in Open Door Technologies, ticker OPEN. And Badger said his claws are coming out for that one. So uh, let it rip. Let it rip. Why,
Well, no,
why are you going to
first of all, you tell us. First of all, you go first. This is your stock. Tell us who they are, what they do, and why you bought stock. And then I will claw your
uh,
thesis.
I thought it would work better to you're the one who I was just hanging off a branch, minding my own business, allocating my bananas as I saw fit, and then Mean Badger comes along, says he's going to tear me a new one. So it feels like
Tell us what the company does. Tell us, and then I'll rip it apart. And then you can tell us why I'm an idiot.
okay. The big overview is that it's an online real estate platform that works with sellers. So it helps sellers sell their home by matching sellers with buyers, and um, basically kind of giving the sellers like a guaranteed offer, and then making it easy. Making it easier for sellers to find buyers using, call it, advanced online technology. I would say that's the bread and butter thesis.
Cool. Okay. All right. Good. So I've got no problem with that business model. I think that's okay. Like, who was the guys who took a pummeling years ago? Was it Zoopla, or is that the British version? It's like Z something. Zillow?
Zillow.
Zillow. Yeah, yeah. I used to be a Zillow shareholder. I think I got out before things got really ugly. As far as I know, like, okay, so that business model makes sense, like facilitating, creating a marketplace, trying to like disintermediate real estate agents and take a lot of the costs out of property. Because, for most people, buying or selling a house is like the most expensive transaction you'll probably do in your life. And you might do it a few times. So the guys that like take the friction and the costs out of that, like that's great, helps everybody. Um, but when Zillow did their like we're going to buy properties and hold them in our inventory, and I like that's when it got ugly. They did it really badly, and I'm given to understand that with their iBuyer program, Open Door have also kind of they're leaning more into that market where they're the purchaser and then they have the property on their inventory and they sell it. I mean, am I right if that is what they're doing?
Well, this is where I could educate you. This that's if you look at the stock chart of Open, it's ugly, and it got into the sub dollar because precisely because they were taking this kind of capital risk. The recent hullabaloo over this company was that the CEO exited, kind of, yeah, kind of forced out, you could say, because there's a lot of discussion about leaving that strategy behind and going into an asset light kind of, let's turn Open Door into mostly a sort of equivalent of an Airbnb platform where Airbnb does not own properties. Airbnb is just the interface, but you know that company extremely well. So that's the sort of um, transition point that the company is going through right now, exactly to your point, because there's immense risk if you're buying the properties yourselves. Now, whether they execute on this or not is a whole nother issue. But that's kind of what got the catalyst going. That's what got my ears perked up. But there's more. But go ahead.
But they still have this iBuying model, right?
Yes, but they're shifting away from it, or at least that's the plan.
Okay, all right. Then look, I'm, okay. Let me explain why and maybe you totally buy this and understand it already, but why I think that model is fatally flawed. But if they're like exiting that model and they're winding down, then all my concerns and my criticism go away. But the reason I am critical of that is like buying properties is not like buying bananas. Like they're not a commodity. Every property is unique and different. And like if I've got an incredible house and people come and real buyers come in the door and look at it and they see the incredibleness and they see that they get their survey done, they see there are no major problems and I'm going to get a premium price. And if I've got like a dog of a house that has a ton of issues, like a wise buyer will spot that and that will be reflected in the price. So like the properties that are going to end up sold on Open Door, because it's chiefly, as I understand it, it's chiefly like algorithmic. They look at like buying and selling prices in the neighborhood and the trajectory. And then I think maybe at the end of the process, I've just read, because I was just trying to skim up on what they do. They send someone in to have a look at it. And that's the only bit that's important in my mind. Like you cannot algorithmically value something like a house because everyone is absolutely unique and there could be disastrous hidden issues in that property and it's only the shit that will end up on your platform. And even if they try and reflect that in the price they're willing to pay, like buyers who are happy to take that 20% haircut from market price, there's a reason why they're taking that haircut. And Open Door's going to have crap on its books.
Okay. Good bear arguments. Not why I took the position, actually. And this is I thought you would go more in this direction. Just for full context, it was the end of the month and I had like $12 left in the account. We add 200 beginning of the month, so the bananas were burning a hole in my trousers, and I'm like, 12 bucks. So one, it is important that this is at this stage, it's not like a major allocation. It's point oh whatever my portfolio. So it matters, right? Because this is sort of funny money in a sense. um, and I openly acknowledged on our trades channel that you should think about this in the meme stockish way. This is not yet, should not yet be a serious investment unless you're doing the trading game and the momentum thing, right? So that's a whole nother thing. But I thought it was valuable enough, or what I saw was good enough to add it to my portfolio in that context, because, and this is where you might be surprised by this, Um, I, one, I do believe, big picture, that the real estate market, as one of the hugest, call it total addressable market, TAMs, whatever, is ripe for disruption, and nobody has been able to really do it. And I followed the Redfin story quite closely for years, so my ears are sensitive to this. Um, that's that's sort of the background. It's this investor activist guy, uh, Eric Jackson on X, that has a history of making big bets on future transformative companies, and he's made bank on a lot of. So he's been successful many times over, and he chose Open Door now to be his next sort of project. Why does that matter to me? I really think this is where I want your ear, Badger. I think investing has become, there's a new layer that's been added historically from where we were back in the 90s and the O's and the 10s. And now, uh, for certain companies, communities are born online that when they're serious, when there's a serious enterprise behind it, you get a bunch of really smart people working together and processing information and gathering information at a rate way faster and way more thorough than, say, any individual analyst could ever do, or even like a siloed investment bank can do, because we're talking about like hundreds or thousands of people. And if you get something like, I don't know, 10 or 20 really, you know serious thinkers and analysts, retail or not, I don't even care. I'm getting rid of the elitist labels, like only an iBank could do this kind of thing. So when I see this really successful activist playing the meme game, his playbook is literally to turn the stock into a meme. He's showing up in front of Drake's house in Toronto saying, Drake, buy a share of Open Door. I mean, he's kind of like a marketer. I mean, this is from the serious investment standpoint, this is like Bush League tactics. But here's what I'm saying to you. I'm not dismissing those as pure casino and gambling and rah rah stuff. I am saying he literally turned the world's investment community onto this company and saying, look, if Open Door could transition from an iBuying thing to basically an asset light AI thing, then it has immense potential. And in doing that, yes, he got a bunch of momentum traders. He got a bunch of people buying and shilling and selling, right? And that, for me and you, has a level of distaste about it, because that's not what you and I do. But despite that, I'm saying that now I get to watch this company with, only $12 invested, and I get to pay attention. I get to follow the story. And when the fundamentals follow and they start making progress, and he's created, a lot of eyeballs on it, it really does have immense potential. That last point in my argument here, the company brass, the new C-level execs, are replying to the community on X saying, here's what we're hearing you say, here are the pivots we could make. And some of these guys actually canceled their what's called their option plans, in lieu of saying, no, we're basically buying shares on the inside because we believe our mission, and it's all right there in the public. So to wrap this all up, I'm saying this is a fascinating moment in time where you could kind of watch a company do its business to some extent in public. And whether it fails or not, that obviously depends way more on the fundamentals, to your critique points, right? To the execution of it. But I want in. I want in on like front row seats with some skin in the game as this unfolds, because there's legitimate substance underneath the hoopla. That's kind of my justification for taking a small starter position.
I find all of that deeply distasteful, I'm afraid. Like, it all reeks of like stock manipulation bullshit. Like, The only thing, as a long-term investor in my mind, the only thing that should be important is like the execution in the company and the strategy and like how they operate and the business model and then ultimately like the money. They're going to eventually they're going to follow some journey and generate net income, but it might be investable all the way along that journey. Everything else is just like fluff and rah rah. And if this guy's making a big noise, all right, okay. One thing you said, fair play. They're doing business in public, so maybe they're taking like the execs are taking feedback, and maybe the strategy will improve as a consequence. But if they're good at what they do, they should have that stuff in hand already anyway, right? They shouldn't need some activist investor, whatever. Often these guys will have an interesting idea. Um, yeah, I don't know. They wouldn't get $12 of my money.
So this is an interesting crossroads for our listeners. uh, Badger, for fundamental reasons. If I could translate, you're saying it's not time yet because the fundamentals. It's too much of a hype story. You don't have enough evidence for execution and fundamentals yet. Correct?
Let me refine that a bit because actually I've done no work on this. I've not looked at it, so I know nothing about the company. I came into this conversation thinking they were doing something deeply broken, but it sounds like they're coming out of that. So actually, I don't really have any substantive concerns. And it's a $3 billion market cap today. So, like, I know, like meme stocks can get way higher than $3 billion in today's market. So, but I wouldn't want to bet on, like, most of the stuff you've described sounds like short term stuff. The only stuff that's important that you described was like the change in the business model, backing out of this iBuyer program. And yeah, I would want to see some evidence of that over a couple of quarters, that is truly what they're doing.
Yeah, and I am adding onto this that I posted one video that I think I watched that's 2 hours long, where I did about, I don't know, 3 hours of research into the fundamentals when before I said, okay, here's my $12. But I really think I don't know how to say this most succinctly. In a, I mean, maybe this is more portfolio allocation strategy stuff. I am convinced that when you find a strong community on X that has serious investors involved, that is alpha that was not available in previous generations of investing. The trick here is, and this is to your point, that many such communities on X or anywhere else, the majority of them are momentum circus, pump and dump stuff. So I want no part in any of that. And I could name you 50 examples, especially in the crypto world, which is it's still bizarre, right? But when I do see legitimate, sophisticated investors getting serious about this kind of company and it's kind of memeish, getting more and more eyeballs, and the C suite is now responding and making alternate decisions because of it, to me, this is classic turnaround in a way that might never have happened this way, like even 3 years ago. And I'm saying to our listeners, like, that's worth one of those tiny initial foot in the door, let's watch this unfold. And that's what I did. $12,
Yeah,
whatever, 4 shares, whatever it was. And I'm satisfied. I
yeah,
don't feel guilty of you know the sins of degeneracy in this case.
that's cool. Yeah, yeah, yeah. Just get like when you buy stuff like this, have a thesis. Like, be clear about why you're buying it, and yeah, I've got no problem in buying like weird stuff, and then you let it prove itself, give it a little while, like see if but you know the metrics you want to watch, and I would urge you to monitor that, like the I guess inventories. I suppose I don't know how they account for the properties, but you're looking for that to come down to like next to nothing, if it is in inventories, because a company like it's a tech company, it shouldn't really have inventory. Yeah,
Yeah, absolutely. And you know who you are listening to this, whether you're on the degenerate side and just buying this because everyone's talking about it, or whether I don't know. I said I put 3 hours of research in it. That was enough for me because I really like the substance of what I heard. Uh, if you only do 15 minutes or 30 minutes and you say, yeah, I now know what this company does, I still think that's closer to gambling, and you should really go deeper before you put something like this in your portfolio. All right,
Cool. All
Badger,
right.
that's enough. That's enough clawing at me. I feel like maybe I escaped with my limbs intact. Let's talk about a legitimately serious company that also has the world's attention. Palantir, PLTR, one of your core holdings in the Wall Street Wildlife portfolio. What's going on with this?
But I'm going to get my claws out again, but not into you, into a particular YouTube commenter, right? So we, if you go back to episodes 90 and 91, and Christoph and I went through every stock in the King of the Jungle, and we did like a 10-minute like bull and bear debate about them all. Like, it's good stuff. It's like, and it's definitely, it's working on like the socials. We got a whole bunch of videos out of that. They're performing really well, and people seem to love them, and they're getting good value out of them. I said, as I was recording the Palantir segment, I know this one is going to get like the dumbest comments and the most hate on um, the YouTubes, because I said, like, I own this stock. Like, I'm not saying it's a shitty company. I own it, but the evaluation is just ridiculous. It makes no sense. And lo and behold, what comment did I get? I got this classic comment from a fella who claims to have 11,000 Palantir shares. So that's a lot of money. That's like several $1 million in stock allocation. He comments, the whole idea of rule of 40 is to disregard valuation. Right. Yeah. Wow.
Right,
What the heck?
right, right. Are we at
Uh,
a market top, Badger, or what?
yeah, for real. Like
Like,
that is like a market top comment, right? I mean, shall I just explain why this is just the peak of dumbassery, or do
yes,
you want to
please
crack?
start us off with, yeah, with what is rule of 40?
Well, here he is. I can do better than that. I can show you the actual rule of 40 for Palantir, which today is uh, 98. That's a freaking big number, right? What is rule of 40? It's like a shorthand way of pulling together two different numbers. And it's mostly you apply it to software as a service companies, which Palantir is one, and it combines growth rate with free or margin, some kind of margin. So typically, I've seen like profit margin, operating margin. In this graphic, they're using free cash flow margin. I think that's a reasonable number to use for Palantir. So you add together like the margin and the revenue growth rate, and you get the rule of 40. And it's called the rule of 40 because the back in like the 2020s and around then when SaaS was like really, really big, if those two things added together were more than 40, it was considered a good investment.
Yeah, and Badger, yeah, yeah, Badger, one quick comment, just for those who are slightly more beginner. The reason this makes sense is because, I mean, just imagine one kind of business like a supermarket. They make a lot of revenue. People are buying stuff, right? So you could have, I don't know supermarkets, but millions, like a lot of revenue coming in. But the cost of all of that eats up most of the profit. So supermarkets are not, in general, uh, a good business model, at least not compared to software as a service. When you're growing fast, so the revenue is growing very, very quickly, which in supermarkets, again, it doesn't. It's mostly steady state, right? You know, you have a good software product. But when you marry that with how much of that revenue you keep, because in software, you make it once in theory and you don't have to keep buying more bananas. You've already made the product. You keep more and more of the revenue. You could see basically number wise how strong the software offering is that you've made. The higher the number, the more sort of proof that you're making a lot of money, you're growing quickly, and that it's a product that has some kind of moat and is not being eaten up by competition. So it's a powerful metric.
It's like a shorthand, but it is a decent shorthand. It's a guideline as to like fast growing, profitable companies that you might want to take a look at and then do some actual due diligence on. So it's a good guideline. And 98 is like a really, really good number. So the rule of 40 for Palantir, like it passes that with flying colors. And this might be like the highest rule of 40 of any company. It's certainly up there. In fact, it's not quite. I'll show you one that's better in a minute. But that's very, very high. So
Preposterously good. It is. It is.
yeah.
It is. It is right. It's out of the ballpark good.
But let's come back to this. I'm going to say, let's come back to this absolute morons comment. The whole idea of
Oh
rule of 40.
no! The claws. Oh.
This millionaire moron,
What if
right?
you unsubscribes to our channel though? Wait,
Sorry.
just for the record, I don't know your name. You might not be a moron. I'm sure you're a very decent person and a good human, but the comment has issues. So let me
Oh,
just be diplomatic and translate badgerese into.
yeah. Okay. Fair. But this guy's got like $4 million in Palantir stock, right? He claims to have 11,000 shares. Oh no, sorry, I got that wrong. This is a stock price of $156. So okay, like $1.8 million, something like that. So anyway, millionaire moronic comment. Let's go back to the comment again. The whole idea of rule of 40 is to disregard valuation. No, it is not. The whole idea of rule of 40 is to help you like shorthand identify fast growing profitable companies. If let's just take it to an extreme, because when you go to the extremes, like you see what's stupid and what makes sense, right? So today Palantir is a $370 billion company and it has a rule of 40 of 98, right? So great. Now, what if Palantir was like a $200 trillion company, right? The rule of 40 is still 98. Valuation is important, right? And I think we're actually at an extreme of valuation right now, not with X $100 trillion. We're at an extreme of valuation with like $300 billion because that's many, many years of growth already priced into the stock. And so they have to, maintain that profitability, which they will, because the business model isn't going to get less profitable, but they have to continue to grow at like an incredible rate for a decade plus for that valuation to make sense. And so valuation is important. And if you've got like, I've got 2% of my portfolio in Palantir. So it's not going to go to zero, but when growth stocks turn, the most egregiously valued stuff, they're the ones that are going to take a hit. So my 2% allocation might go down to like a 1% allocation, and I'll boo-hoo a little bit because I lost some money, but it certainly ain't going to wipe me out. If you've got the large majority of your investment portfolio in a company like this, it is going to freaking hurt. So, I mean, you do your own due diligence, manage your own portfolio, but at some point when the money gets big, as it is for this guy, presumably, you've got to start applying some portfolio management, diligence, and a bit of margin of safety and start diversifying into other stocks. Like we'll talk about that a bit more when we answer Patreon Hugh's question at the back of today's episode.
All
But
right.
yeah,
Yeah.
maybe enough clawing. Actually, just one more.
You could one more scratch. Get
One
one
more.
more in your
Yeah.
badge.
Let's just look at how out of kilter Palantir is. So here's a pretty picture. It's pretty small, but if you can read this, I put like an arrow to Palantir. This is rule of 40 along the x-axis, and the y-axis is like valuation. Enterprise value is the next 12 months revenue. So Palantir is way outlier from everything else. There is a stock that has a higher rule of 40, app, APP. I don't know much about them. Is that App Lovin?
Yes, it is.
It is, yeah, okay. Another Mimi stock, but I'm not prepared to talk about that at all. I've known nothing about it, but has a higher rule of 40, and it's valued at a much more reasonable, like what, 27, 28 times revenue. But Palantir's up there at like nearly 80 times revenue with its 98 rule of 40. There's a reason why stocks might justify the valuation. And so, highly valued stuff like Cloudflare and who's Fig? Is that Figma? Well, they got acquired, right? Yeah, it's Figma. Okay, maybe the acquisition hasn't completed or the data's out of date. Like there might be a reason why those companies enjoy their 30 times revenue. It's very hard to make an argument for like nearly 80 times revenue at Palantir. So, Yeah, there we go.
All right, Badge. I got a little bit of nuance here. I think what you said is absolutely correct. This commentator is wrong because valuations always matter. And it's when we get to the arrogance stage, stonks only go up. This is kind of one of those data points, right? People just fool themselves, and it's going to be painful. However, here's the trickier part. I have learned, we, I'm sure, together have learned the same lesson that when you do find a generational company that's truly excellent, it will always be expensive. So people make the mistake. Often we've seen this millions of times. I've made it myself plenty, where you think to yourself, oh my God, it's so expensive. I'm going to wait till it gets cheaper. And it never does, because lo and behold, it's an excellent company. So the market knows this, and it's always going to pay more than the laggards. But that is not the same as ignoring valuation completely.
Yeah.
There has to, I don't care if you discover a diamond mine in your backyard or a banana plantation that, grows a new banana every single day. There's a price at which it's too much to pay for all those bananas and diamonds,
Right.
right? That we could all logistically agree that's the case. If somebody says, your bananas, they're worth $80 trillion today, I don't care how fast it's growing, how delicious the bananas are. The correct thing is to sell, because that's an insane valuation. So this commentator is confusing. He's confusing valuations don't matter with good companies are always expensive, and uh, it's going to go forever, and all of that. So thanks for bringing this to our attention.
You got it. You got it. And I'm going to do this guy a favor because he helped with his comment. He prompted like actually a good discussion. And I know we took the piss remorselessly, I did, but like I think there's some learning here if you open your ears. So I'm going to post a link to this episode back to him and say, like next week when this goes out, and say, do yourself a favor and check it out. And then let's see if he comes back to us with any rebuttal. I mean, if he wants to tell me I'm an idiot again, cool, whatever. But let's see what we get from this.
Yeah, although you know what, one more thing, since we're gonna continue this. He said something like in the comment, right, that he bought at this price and this price and this price, and lo and behold, it keeps going up, right?
Yeah,
That is a kind of, I think, cognitive error in a sense, because it's the resulting thing we talk about in poker, right? Just because you won the hand doesn't mean your process was correct. Now, sure, when you're in the market, it's all about money, and I could make the argument, like with open, that as long as I sell higher than when I bought, I don't care that it was a meme stock, or I don't, there is that angle of it. Uh, but by his logic, saying that it's more likely to get to 250 than 175, he's this reality distortion field comes online after a certain point.
yeah,
I think he's in it right now. And we hope, if we're doing our legitimate job of helping people, that he could at least hear why there's a problem with what he's doing, and potentially, if not outright sell Palantir, trim, right? And that's what you did, right? Or maybe he has 20 yachts, and it really, he's eating Palantir stock shares for lunch. Maybe he doesn't need to, but that's a whole nother thing.
yeah, that's fair. All right. Anyway, I've kept you anonymous, but you are named on the YouTubes. Like, I'll post back to you. Let us know what you think. Okay, let's talk about a company that is not controversial and will get no clause because I just bought some stock in it myself, and it's one you are a big fan of. Tell us all about Iris Energy.
All right. Well, I'm not going to go too long into IREN Energy. They used to be called Iris. They changed their name. Check out our shorts on YouTube. I give a high level overview, 2 minutes. So yeah, go research that in previous episode. I want to start. Yeah, well, let me start with by one explaining a comment I made on our Patreon page, which I kind of did tongue in cheek, and I was waiting for this episode to give more substance behind it. On Patreon, I linked the earnings call results. I said they were sensational, and I linked a clip to the famous movie. I even forget what that movie is called, where Tom Hanks is the captain and the pirates take the boat over, and it's that memeish clip of the guy saying, look at me, I am the captain now." It's a great clip. But I was actually I had a serious point to make. Here's why I think shares were bid up so massively after the earnings call. Up to now, one of the kind of most juicy catalysts that was lurking in the sort of shadows was that IREN had, because they had built out this massive power infrastructure, land and electricity and permitting and building the data centers, that we were waiting for one of these major AI players. Is it going to be Google? Is it going to be Meta? Is it going to be OpenAI? Is it going to be whomever, right? We're just waiting for one of these guys, these hyperscalers, to say, okay, IREN, we pick you. We're going to lock ourselves into this 5-10 year deal, and we're going to pay you crazy amounts of money per megawatt hour that you could provide us. And then based on that thesis, stonk will move, right? That's what I was operating on, like most people were, mostly, right? But on this earnings call, we kind of, if you could read the tea leaves, we heard something a little different. IREN basically came out and said, look, the supply relative to demand is so misaligned that we are at the forefront of this of building this stuff because we thought of it years earlier. So everybody else is one playing catch up, and these hyperscalers are not waiting around. That's one point. Like, we are in the pole position because we were first, and we're good, and we're doing this. That's one. But two, they partnered with Nvidia. They're now, when there's some conference coming up, sponsors get their logos posted in terms of how how tightly knit they are. IREN is like second level down from whatever the first sponsor is. So IREN and Nvidia are now preferred partners, and basically Nvidia is saying publicly, like, these, go to these, you want to work with us, you go to these guys, we're a team. That's hint two. Three, and this is going back to the slide, IREN is now saying, Luke, that, wait a second, we've been buying all these thousands and thousands of GPUs successfully. We financed all of this. And yes, we could co-locate and, basically play landlord to some hyperscaler at a rate that obviously makes sense for them, because why would they do business with us if it didn't? Or, drum roll, we could become a hyperscaler ourselves. Because hold on a second, we own all this stuff. I mean, they lease the GPU, but we already have grown the stack ourselves. So why can't we become the next Google, AWS, or Azure or something? And this is not a done deal yet. I'm not saying this is like, it's complicated. It's actually complicated because there's a bunch of moving parts. But the reason that this is a huge honking deal is because IREN now, going back to that, we're the captains now. They have all the data, and they could either do some part co-location, rent out some, or they could go it alone at an appropriate time when the market dynamics shift. And I'm going to use the Netflix analogy just in a weird way. I think one of the reasons Netflix has become this massively huge company isn't just that they invented streaming, but they had the data, right? They had the data, and they knew which shows to pay for and which shows not to pay for. That's what IREN is saying publicly now. We know which way the market's going to go. We have Bitcoin basically helping us fund all of this. And some people in this moment, Badge, are saying if this kind of plays out the way the tea leaves are pointing, the $26 whatever $7 billion market cap we're at now, or 5 billion, I forgot what it was after the big jump. Maybe you could check uh, right now where we're at with the markets are closed, but whatever, 4 to 7 billion, that's still teeny tiny potatoes if in fact they leverage this playbook. So not without risk, because there's higher capex expenses, there's depreciation of all the semi chips and so forth. But we're looking at a paradigm shift, in the face, the possibility of one, and these are through and through 10x opportunities. Depending on execution and how AI plays out. But the one thing that delights me about this company, and I've listened to their earnings call now for 2 years, just about, these guys know how to execute. And so that's another huge plus mark. I mean, these guys are just they've been doing this for a long time. They have the network connections. They just play the game at a higher level than anybody else, which kind of got me into the door way back in late 23.
Yeah, that's cool. And I've come on board as a shareholder now. I hadn't seen that comment. I think it's a bit early to say like, oh, we're going to be the next hyperscaler. Like that term has a particular meaning.
Well, I want to clarify. I do want to clarify. They didn't say we're going to be. This is where the nuance is. They're saying, maybe let me be as accurate as I can, between co-location and becoming a pure hyper cloud, there's a bunch of, call it, degrees in the middle, like percentage points, if you will. And IREN is saying, stop thinking about us as a binary, we're Bitcoin. Certainly, we're no longer just a Bitcoin miner, and stop thinking of us as just waiting around for a co-location deal. We ourselves have the capacity to do some of this stuff ourselves, and the extent to which we'll do it depends on a bunch of stuff, but it's right there in plain sight. So don't be surprised, market, when
There's one thing I saw in my due diligence which might not undermine but make that trajectory a bit more difficult. But as you say, they have the data, and I'm sure they're going to navigate this successfully. But like their business model is founded on building data centers in locations where the cost of energy is really cheap. That might be by like a waterfall and a dam, or an area with like incredibly windy. There's various like ways of harnessing natural resources to generate cheap power, and then they use that cheap power to profitably mine crypto, which today is Bitcoin, but they can mine any crypto in the future. They're basically turning like wind and sunlight into dollars, and then they're turning those dollars into like buying even more and more hardware, and then they start selling that hardware to end customers. And I think they're building data centers in other locations as well, but that like base part of the model is kind of founded on the cost arbitrage between like buying or generating the power and using the power to create money with crypto. So they're
partly,
always
partly in crypto, they're financed with other stuff too. But
sure, yeah,
yeah,
yeah. Because what that means is typically their data centers, on average, will be in more remote locations rather than like a data center in New York City where power costs a lot of money. And at some point, like latency is important for certain kinds of
it's huge.
customer need. Yeah, yeah, yeah. So I would imagine, again, I don't know for sure, I would imagine that IREN's business model is really effective if your customer doesn't need super low latency, like instantaneous response in, say 10 milliseconds.
Badger, yes, may I? I'm glad you raised this, but you have a very common misunderstanding here. So this is great that you brought it up. Logically, what you said makes sense. However, this is the genius. This I don't know if genius is over stating the case, but these guys picked Texas specifically years ago for this very reason. There's a pipeline. I don't know. I'm not an engineer, so I can't explain it beyond uh, that. There's Dallas, or they call it the Dallas area in Texas, is connected to this triangle to the east of Dallas that's connected by, I don't know, call it a super fast uh, data pipeline, so that the places that they invested in Texas, which you would think had high latency, meaning long delays, actually has really, really short latency. So they have already preemptively solved this problem, and counterintuitively, being in Bumblefuck, Texas is much better than being in some other area, and that's why they chose it. So they're yes, they solved this problem already.
Well, they haven't. Right. Okay, I hear what you're saying, and you're right. But again, my caveat applies, like for certain kinds of customer. Okay, let's look at like Cloudflare, like ticker net. They're kind of, if there's like the hyperscalers are really like Amazon, Google, and
Azure.
yeah, Microsoft Azure. They're like the hyperscalers, and I guess they're considered the hyperscalers because if you have a business and you're tiny, you don't have much money, but you want to have like a web presence that's really responsive everywhere in the world, whether you're in Bumblefuck, Texas, or you're in like New York or London or Hong Kong or Singapore, or you engage with like Azure, GCP, or what's Amazon's one's called?
AWS.
AWS. You engage with those because they will deploy your stuff in such a way that it's like super low latency, very responsive everywhere. And Cloudflare were kind of positioned as maybe like the fourth hyperscaler. And they're a much smaller company, like $70 billion market cap compared to like trillions of dollars. But even Cloudflare have apparently over 330 cities where they have infrastructure like data centers. So they are like right there where the traffic is coming from. And so what you say is right. Like they might be on like, one of the high capacity highways in Texas, and they might be low latency for customers who are, I don't know, geographically in North America. But if you expect to have customers in Hong Kong, let's say, or London, well, you need a hyperscaler that can deploy your stuff in all of those locations, not just in certain ones. That's kind of it's a nuance. It's a nuance, and it won't impact everybody. Like I'm sure with the data and the intelligence, they will court the customers that make sense for them, but they ain't a hyperscaler.
Great distinction. I know Cloudflare very well, or I used to. It was my first recommendation back in the seven investing days. And what you said was actually one of the main ideas. They're just set up all over the place geographically for latency issues. I think I can. Let me add this corrective regarding IREN. This is maybe where I misspoke, or maybe my understanding is not quite there yet. I believe Texas was named through the Stargate initiative, like that. The AI build out or infrastructure is going directly to Texas. That I think OpenAI is setting up shop there. So there's some magic Bermuda Triangle area in Texas specifically that's going specifically to AI stuff.
Sure.
So it might not, right? So that might be the difference. Like that there's the call it global thing that Cloudflare is doing versus being fast enough for future AI project. And IREN is saying we're all in on the AI, and maybe that's the misnomer. Maybe that's not technically a hyperscaler. Maybe it's some new variety of it. But the overall point is that latency matters. IREN deliberately chose Texas for a reason, and they have the potential to be one of these big boys doing something beyond renting out their space.
Cool. That's good. I like it. I do really like the company. You turned me on to it when you told me about it for like the 10th time. I should have listened to you the first time. Um, and I'm also now a shareholder. There's one other thing you put in our show notes that I don't understand, and I'm keen to understand. It's your what lessons can we spot? Can you break that one down for us?
Yeah, I actually intend this to be an open question because one of the things we do over our Patreon is every time we make a trade, I put in my spreadsheet and then I notify our members. And so when I look back at all my trades, the IREN, you could see that, my goodness, it's been like what, 20 trades of iron, and kind of eyeballing it. I sold. My first buy is for the King of the Jungle purposes, February 20th, 2024, where I bought at $6.84. And then you could see in the next column I sold that June 7th for $11, getting a 60% return on those shares. And basically right now the current status is kind of, yeah, it looks half and half. I sold the initial batches, but then I started rebuying again uh December 2nd, 2004, all the way into April 4th is the magic one, where I bought 5 shares at $5.27. That's at 400% return now. So I was looking at this and I was wondering, what lessons uh, are there here? Would it have been better to have bought them and never sold them, or was there something that was smart in here, or is there something that's an obvious mistake? Now, my spreadsheet shows that had I kept those initial shares and never sold them, that I would have, for example, the 684, that batch of those first shares, I missed out on $154 had I not sold them. So the missed revenue is quite significant, right? So that's a case for, if you buy a company, just stick with it. But as some of our patrons pointed out, a couple of people said, but obviously I did something with that money. So one, I netted profit, right? I wasn't selling at a loss. So anytime you make a profit in the market, you can't be too hard on yourself. But I reallocated those. Some went to EO, some, and obviously that went up a bunch of percent ASTS. So it's kind of hard to say. I can't remember exactly where I reallocated. But another point that was important for me to mention, this is an example of a company that I've been now playing with, you could say, for close to 2 years. Something happens, Badge. Tell me if I'm wrong. I know you don't trade as often as I do, but when you develop a relationship with a company over time because you follow the story and you have a track record, y- I call it, you get more sensitive to that company. You kind of learn its sort of peaks and valleys a little more. You know what you're listening for on earnings calls. You know when there's like maybe a waiting period coming up. And holistically, I look at this and I say, sure, I could have bought and never sold, and maybe I would have more money net net. But I also, this is evidence that I learned more and more about this company over time, and it was time to continue doubling down on it as the price share kept going down. I had more and more confidence to do that because of this ongoing relationship. That is hard won. You can't do that overnight. Uh, and some of it might have cost me, but it was easier for me to rebuild the position after selling it. Is maybe another point.
Right.
Um, Now my decision really is: do I add more? I think at the highest price point it's ever been, or do I have enough? And for new investors who don't yet own this, your big question is, do you have a cognitive bias that says, oh, well, Monkey bought at $5.27 and 626, but now it's already $26. Obviously, the boat has sailed, so I missed it. Wah, wah, I should have paid attention to him. I think that's the wrong lesson. If you do your research and you listen to the calls and you see what I see 5 years from now, when it's whatever, hopefully 5x, 10x, you'll say, yeah, 26 was a bargain. So establishing this kind of track record that you could look at You could post to people, you could get feedback on, you could ask an open question. Like, this is priceless in my humble opinion.
Yeah, that's cool. And like I bought at $20, I bought it in my real money portfolio, and like directionally the same in the King of the Jungle. No, I didn't buy in King of the Jungle because I wanted to respect the fact that this is yours, and I don't want to like straighten your boots. Yeah, like I mean, it's like another version of price anchoring, right? That cognitive bias we get hooked on. We anchor to either the price we paid or the price that like it's recently traded at, and then we start making judgments based on that. But price is irrelevant; it doesn't matter. Like, what it matters in terms of valuation. The thing that matters is like where is the company on its trajectory? How is it executing? What do you think it's going to do in the future? And I thought when I looked at it like a couple of weeks ago at $20, I thought, yeah, Christoph's right. There's a good thesis here. This company has a lot of potential. I'm not going to trade in and out of it. I'm just going to like I can't remember like a 1% position. I'm just going to sit on that now for 6 months. And if I like what they're doing and they're continuing to execute, then I might add some more money at maybe $50 or $60. I don't care. Like as long as it's executing and I still believe in the thesis. I don't care what you paid for it. I don't care how it traded in the past. You should only care about like the valuation today on the date where you make your decision to buy it, sell it, or continue to hold it.
Right. I do want to openly say this is leaning a little towards the getting cute column because, I do use some crayons in my charts, and, that has obvious pros and cons. But I do want to, in this case, I think I played the game and I won. And I
Yeah,
just want to point out one data point as an example. Uh, if you look and you'll see that, for example, I bought on March 15th, I bought 5 shares at $4.59. And then I sold July 2nd at 13.49. That was close to 200% profit, right?
yeah,
I sold at 13.49 July 2nd. And then notice that I bought back the ones that are open now, uh, December 2nd, 2024. So that's like what, 5 months later,
yeah.
at a price that was just a little bit lower than when I sold it. So luck and the bluebird of happiness pooped in my eye, or whatever. But in this particular example, I would color it this way because, and actually, I remember now when I sold it, it's because I think that around that earnings call, we were more in the okay, we're building this out and it's going to take a little bit of time. And yes, we have people interested. And to me, I remember thinking, okay, this is like 6 months from now kind of thing. So I was more confident in saying, okay, I have better place for the money. And I got lucky with the timing enough to get back in when it was still cheap. But there's the record.
All right, good stuff. I like it. Thanks for bringing this one to our attention. Okay, shall we tackle a classic question? I know this has been a long conversation, but I really want to touch this topic this week because we started a program on our Patreon a while ago where we said, hey, if you guys have got any questions for us, like type them in, that's cool. And we do that all the time. We answer questions from the Patreon, but if you're up to it, leave us like an audio message or leave us a video message. And we got our first video message from our new Patreon, Hugh. And I would really like to get my teeth into Hugh's question because I think it's a good one that we talk about in the past, and I think we should just kind of refresh our position on this one.
Hello, Badger and Monkey. My name's Hugh, and I'd love some advice. I'm just taking the plunge to invest my own pension, and honestly, I'm finding it quite daunting just deciding which 30 or so stocks to invest in and how much of the portfolio to invest in each one. So, any advice on starting out as a long-term investor would be much appreciated. Thank you.
So let me summarize Hugh's question. Basically, he's investing his own pension. He's finding it a bit daunting to decide which of this 30 or so stocks he says he wants to invest in and how much to put in each one. So basically, like this is, how do I start out as a long-term investor? That's kind of his question.
Good question. It's the perennial question we always go back to. First of all, thanks Hugh for joining us. It's a jolly crew. The first thing that jumps out at me, and there's so many things we need to cover, but the first fundamental point is, it seems to me you want to just op- you want to sleep at night. It's the sleep well at night quality, especially when you're a beginner, because it can get and it will get scary. I would say psychologically, uh, allocate some amount of money into a investing portfolio that, should that go to zero, theoretically, you wouldn't like it, you wouldn't be happy, but you're not going to be out on the street, Hugh. It's a psychological. It's like the first steps where you want to, the trades you make, like in poker. Um, Good poker players, the aggressive ones, the ones that you're up against a real player, they are willing to risk their whole stack when it kind of becomes necessary, because they know they're not playing from anxiety. They're not going to be bullied. And I think that's a kind of important first step. Don't bet at all, right? Go slow. How much are you willing to risk, and you be okay with losing, and start there.
Yeah, and you're leaning there on like two of our 10 laws of the jungle, um, like know your investment comfort zone and protect your essentials. And you're right. Like if you're, I think Hugh's question is actually, it's got an interesting nuance because if I read between the lines on Hugh's question, he's actually investing his pension. So, like in the UK, you might have, say, a workplace pension. I used to have one with my employer, HSBC, and they kind of manage it on my behalf. And I had some really limited choices as to what I could put that in. And then when I left the bank, when I quit, I was able to withdraw that, put it into what in the UK a SIP, self-invested personal pension, and I just manage it like another brokerage account. So it's like one of many accounts I now manage, and I have individual stocks in it. So I think probably Hugh is, I would guess, doing something somewhat similar. And if you're a newer investor, like newer to picking stocks, you probably don't want to like dive in with, if it's like your pension, that's probably important money and it's a lot of money. Um, and so you probably don't want to dive in and like throw that into, like wild companies that you haven't really learned your investing lessons yet. So with someone like Hugh in this situation, if he's new to analyzing companies and he's new to building like the emotional resilience and the skill set, he probably wants to keep, if he's self-managing his pension now, he probably still wants to keep the large majority of it in similar things that he used to own, like, big passive index trackers like VOO, and so VOO and VW, RL, like some big, track the S&P, track like the FTSE, track the all world, have the majority of your money in those, and maybe have an allocation, which is like essentially, if you're really new at this, it's like your kind of practice money. I'm going to learn some real lessons. I'm going to have some real skin in the game. Let's say you've got, I don't know, like $500,000 portfolio here. If it's your pension, it might be like big numbers. Well, maybe 400,000 of that is in like this, not so much safe stuff, but it's in like market tracking, easy, like stuff that, like the kind of things that the pension's probably always been in. And maybe you got some bonds and some fixed income, like for like, we're not financial advisors, like do your own due diligence, do like standard stuff. But maybe you take an allocation of that, 50 grand, 100 grand, whatever it is, like a percentage, and that's kind of your learning money, where you're then going to pick a bunch of stocks. I don't know about 30, we'll come on to that in a sec, but pick like a number of companies, and we'll talk in a minute about how you pick those companies, and put, say you had 15 companies and you had $150,000, we'll put $10,000 in each of those 15. And then you're going to start learning some lessons like right away, because some will go up and some will go down, and you'll feel some exuberance and you'll feel some pain. And then you start improving your process over a course of years. And as you become more confident, maybe you start to move some more of that like passive money into your actively managed personal money.
All right, Badge. Some more nuance there. I want to introduce the concept of cash as a position.
Mm.
So I would add, Hugh. Uh, I'm going to give a real number. It's easier for me to talk about. Let's imagine $10,000 is your, call it year one. I'm in year one. I'm learning how to do this, and I'm going to use $10,000 with which to learn. Very
Yep.
similar to what we did with King of the Jungle, right? Except we started with 1,000, right? But now you have $10,000, right? So, as Badger said, you got your index funds, you're familiar with those, not much thinking involved there. But let's say you take 25% of the 10,000, so $2,500, and you put that in cash,
Yep.
right? Now you think of cash, hopefully it's also gaining some interest if you pick the right broker. So that cash is actually also making you some money, or at least keeping up with inflation. And now, before you go ahead and buy any companies, uh, since you listen to our show, I would encourage you to look at Monkey's portfolio, look at Badger's portfolio. Maybe start with the top allocation because obviously that's where we have most conviction, right? And then before you buy anything, you do your homework and you spend, like, I don't know, I hope it's not overwhelming, but you spend 4 years studying EOS and I'm sorry, 4 hours studying EOS. I spent 4 years studying EOS. You, Hugh, don't need to spend 4 years. Spend 4 hours studying EOS. Spend 4 hours studying Rocket Lab. Learn how to do that, right? There's lots of questions about how you do that, but go to their investment presentations and dig around, right? And then if you like the story, right, and you feel you could explain it to somebody, then out of the $2,500, I would recommend you make something like a quarter size purchase. That's your foot in the door. So I don't know, that might be whatever, 10 shares of EOS, 10 shares of Rocket Lab, and then you're in, right? You're already in. If that all blows up, you've lost basically nothing, but you've taken the most important first step.
And let me, like, that was all good. I totally support all of that. I want to point at one or two extra things that are really important. Like, you can go and listen to other podcasts and read other analysts and look at like the Motley Fool and Seven Investing and services like this. But the most value you will get is from going to primary sources. It's easy to do these days. Go to, like, just literally Google, say it's Rocket Lab, like you picked that one, or EOS. Just literally Google Rocket Lab IR, like investor relations. Top of the fold, like first couple of results, you will see Rocket Lab's own website, their own investor relations page. Virtually every company, I've never found one that doesn't have like this stuff nice and easily laid out, easy to access. If you're really getting into it, download like the actual financial reports. If you want to keep it real simple, they'll probably have like a 10, 20, 30 page like PowerPoint, like PDF deck. Just read the deck. Like, bear in mind, you're reading like their own, it's got to be factual because there's various laws around, regulatory laws around what they can say. But you're reading like their optimistic take. So, have that filter in your head, but understand the company that way. You'll see probably a bunch of pretty pictures that will really give you a good essence of who they are and what they do. And then, when you want to get a bit more advanced, listen to the earnings call. If you go to an app, Quarter, Quartr, it's fantastic. It's free. They've got like the audio of the earnings call. I'd recommend like listen to it because you get some human nuance from just hearing the voices. Try and understand the analyst questions and why they ask that question. Even if the company gives a flim flam answer, there's often a reason why the analyst was asking that particular like line of probing questions that might give you like a hook to do some of more of your own research on. And then if you want to get more advanced still, start looking at really at the financials, by which I mean, not just like the Yahoo Finance page. Go and look at the income statement, the balance sheet, the cash flow statement. If you go to a tool like Fiscal, no, sorry, yeah, no, they are fiscal.ai. They used to be FinChat. Go to fiscal.ai. Like, the free tier is very, very good. And if you're looking at like a small number of companies, you've got some great data there. Go check out fiscal.ai, sign up. Or if you sign up at fiscal.ai/wildlife, you'll get like a handsome discount. But the free tier is good enough to do this like initial research. They've got all of the financial statements there. They've got a ton of other data there, and just start understanding what some of those numbers mean. And if you've got one you don't understand, like ping us on the YouTubes or ping us on the Patreons, and we'll try and help you figure it out.
Yes. Badger, hearing you explain that and trying to put myself in the position of a beginner, which is kind of hard for us, but I think there's a one major I could see a ditch, a pitfall, where to us it sounds like no problem. Okay, I look at the investor deck and I look at financials, and we've been doing this so long, it's like nothing scary. But to a beginner, it could begin to feel overwhelming, especially the financial statements, because all companies, it looks different and they manipulate things, gap, non-gap. Like there's a bunch of stuff. I could be like, okay, fuck this. Like, I'm way over my head. I think before you get there, Hugh and everybody else in the beginner path, start more Peter Lynchian style and start by doing what I said earlier. Uh, Look at our King of the Jungle portfolios, because we've curated what we think are the best companies, that we know of, and we do this a lot. I'm not saying that's the only companies, but between Badger and Monkey, you have very different kinds of companies. And then do let's make it simple. Do 1 hour of research per company, right? And now, to not make you feel overwhelmed, do this for only 10. Right? So let's say, to make it easy, pick 5 monkey companies and pick 5 badger companies. So now you have 10 companies, right? Here's the important point. As you do this research and you begin to understand, start your own spreadsheet maybe and just rank them in terms of what you think, just completely like holistically, which company did you really enjoy learning about? Have that ranked. Make it be clear. Let's say it's Rocket Lab. You're like, man, I love rockets. Cool. EOS batteries. Who gives a fuck about batteries? Like, no, right. But you'll have a good sense of pecking order. That might be enough to then allocate appropriately, as long as it's not a lot of money, based on the initial understanding. Then, as time goes on, and earnings calls come out and more info, then you could start making adjustments. But that's a fantastic place to start, I think. And one more point, Badge, and I'll let you take over on this. I do think, because of information overload, it is very easy to pick too many companies and too much information, and before you know it, you've just made another index for yourself. This step is intended to really get you selecting. I call it 10 because that's a nice round number, and at the beginning that's plenty to keep you busy.
Yeah, I agree. Like 30 is probably too many, even in a mature portfolio. 10 is maybe a bit low end. Like some people have concentrated portfolios of like 4 or 5 stocks. That's outside my comfort zone. I think generally accepted wisdom is, if you have, say, 12 to 15 stocks, and if they're broadly diversified, then you've neutralized a lot of that like exposure risk. Like you have enough diversification, and every additional stock probably doesn't materially improve your diversification. Obviously, if you own like 15 companies and they all do exactly the same thing, you've got no diversification at all. But I love that way in, actually. Maybe we've never said that so clearly, so kudos to you, Christoph. Like literally an hour times 10 companies, and pick like the handful, the 3 or the 4 that you just like the story of the most. Like actually enjoying researching a company is really beneficial. It might sound dumb, like who cares? Like, who cares if I enjoy this or not? Is it a good business? But if you enjoy reading about the company, you're going to probably enjoy doing like more deeper research in the future. So you're going to learn more about that company. And if you become like a bit more of an investing geek, the algorithms, the YouTubes will start pushing more content to you because you're just naturally reading about that stuff. And if you're out, say it's a company operates in like an area where you have either like expertise or a hobby or experience where it's just like a thing you're passionate about, like I know, freaking like sailing or something, and maybe you found like some brand that makes yachts or produces like clothing or does like ocean mapping or something, right? It's an industry then you'll be reading about because of your hobby around sailing, and you might see this company's name pop up for good or for bad just in the course of like living your normal day. So you're getting like free due diligence because it happened to be something you liked.
You know what? As you were saying that, I could hear some called professional level investors being like, "Ah, these guys are just, like just buy because you like the story. Like that's some amateur shit."
Right.
I think that's a mistake.
Yeah.
I mean, okay, if you're a professional, obviously, but you're working for
You're right. There's a nuance here. Go on.
right,
Yeah.
yeah, you're working for a bank. You it's your job to understand every tiny detail on every statement. But I have to reiterate that all the best investments in my career, had I not sold them, all were born because I loved and cared about the company on the story level. I know this is, I've beat this horse to death, but if we're talking about Apple and Netflix and Tesla and Nvidia, and like these are Chipotle. It's weird, right? But all I had to do was like the story, continue to make sure it's playing out the way I thought. And had I not sold because I got too smart for my own britches, then I would have way more money than I do now. So it does not actually have to be more complicated if you're a long-term investor. That's the weird thing about this.
Yeah.
I'm not saying that's the only way, but that really is sometimes enough. And then you add the nuances and a lot of other stuff.
And the like you cherry picked your winners there, but let's use an example of a loser, and I'll give one of mine to explain like why this works. Like what we're describing is just literally how you get started if you've got you don't know how to value a company and you're not looking at like primary sources, you're just kind of buying what the latest stock recommendation service told you to buy. Like buy the stuff you like, because then you'll enjoy studying those companies. And let's say eventually over the course of maybe you do like 10 times 1 hour today, and then next month you do like another 10 stocks, another 10 hours. At some point you've got like 15 or 20 or maybe 30 stocks in your portfolio. You have to keep studying those companies, and if the ones you enjoy are the ones it won't feel like work, it will feel like interesting to study those companies, and you'll watch them over the course of a couple of quarters, and some will perform well and some won't, but you will start asking the right questions that make you a better investor. You'll be like, oh, why is this stock down? And you've got like a rabbit hole to go down, and that's where you start. Then you've got like an entry point to doing like the real job as an investor, actually studying companies, but you've given yourself like an easy way to get going.
Yeah.
If I lean on one of my losers in the past, like going into the pandemic, was it pandemic? No, it wasn't pandemic related. Beyond Meat, like I really like Beyond Meat as a brand. I'm like, it's like these are tasty burgers. I bought stock in the company, um, and then because I enjoyed researching the company, because I'm like it's helping the planet and it's mitigating like animal slaughter and all these horrible things. Like I like this investment, and then because I was researching it, I started to notice, oh, like hell, like in the grocery store, like Beyond Meat is here, but they've got like 50 competitors all selling the same product. Like this plant-based like aisle is getting bigger and bigger in my local grocery store. So I started asking like the sensible question, like, is their product really differentiated? And then I ate like, burgers from other manufacturers. I'm like, these are really the same thing. I literally did like a blind tasting with like three different kinds of burger, and I could pick out the Beyond Meat one because I knew it. But I'm like, maybe it's better, but this is like a matter of taste. It's not that much better. So I got out of my position, and like now Beyond Meat, I think they've actually just become insolvent. Like they went bankrupt. Like they've been in big trouble for like a year, well over a year. So that hopefully by giving an example of like a loser, it's the value is in doing the ongoing work.
Yeah, absolutely. Lululemon comes to mind actually in this kind of topic because that in to your point about cherry picking, I could see somebody loving Lululemon, but if you invested at the top, you're quite underwater now. But from an investing standpoint, forces you to ask the right questions. So it's not that it's so easy and you'll only have winners, but there's lots of examples where I think this is the correct entry for most beginners, and over the long term you're likely to make a lot of money regardless of your financial statement literacy or not. But
Yeah. But those skills will come in time as you study companies. Each time you look at it, you'll learn a little bit more. You'll figure out the stuff like I don't really understand what this number means or this company's saying, and that's like a hook to do more research and improve your not just your understanding of that company, but your skill set as an investor, which will then benefit you when you look at every company.
yeah. All right, Badge. So I think there's a lot more to say about this. Maybe we'll do a part two because this is part of this is our bread and butter. Helping people just get started. So a lot more things to say, Hugh. But I hope that's a good start. However, Badge, you do have a recommendation for a broker, correct?
Well, that was a big episode, and yeah, like we'll keep coming back to that Hugh question because it is like the classic question. And if there's deeper questions or you think we, didn't go deep enough on some aspect, like tell us on the YouTubes, tell us on the X's and the Patreons, and we'll explore that because you're right. Like that's our mission. That's why we're here. But we have done a ton of labor over the last 90 minutes recording this episode. I do want to say Happy Labor Day to you. I think that's like it's a holiday weekend in the States. Is that right?
Yes, it is. Though I only teach, I don't teach on Mondays. So to me, this Labor Day is useless because other professors have off on Monday, but Monkey's always in his hammock on Monday anyway. But Badge, so this is the first time I think in a while that both you and I are back in our home bases. I've had quite the adventures in Sicily and Poland and Greece, and you recently were also making like a pirate, floating off the waters of your fine Great Britain islands or whatever you got up there, and then you went to New York City, right?
Hmm. Yeah. Boston and New York. Just got back yesterday. Yeah.
So I don't. Monkey was New York was his first. That's where I grew up in New York City. What's she like? Smelly, dirty, smellier, dirtier than ever. Seeing thing you loved.
Maybe a little grubbier. Maybe this is like my fourth office visit to New York. So I don't know the city well, but like I've certainly been there a bunch of times before. Busier, maybe busier.
Where
Uh,
were you?
we were staying actually like a really fancy hotel, but by Times Square, so like the classic like tourist trap area. I've got a good friend who lives in the city, and she's like 5 minutes from there, so we wanted to be like near to her. Um, Boston was beautiful. Like we got a buddy there we visited. Like Boston is still fabulous. It's caught up with us a really close old friend who lives in New Jersey these days, and then a couple of days in the city to go to like the US Open. We caught a Broadway show. Yeah, I did some admin. I bought a new laptop. So yeah, with the FX rate as it is right now, I've made a bit of a saving on the laptop that mitigates some of my hotel costs.
Okay, right on. I have a love hate relationship with New York because it's where I grew up. It's where I learned English. Saw my became an American in New York. Classic immigrant story. I also was there for 9/11, and
Yeah.
I it's just such a it has a obviously you can't recreate the place where you were born and you saw the world change before your eyes, but it's it's a special place, and I'm at the point where it's I actually love visiting New York because I know it well, and I know I don't have to live there, so I could get go 2 weeks is or 1 week actually, and some is enough.
So you wouldn't move back there. I know, like you escape the Austin heat, like the worst of the weather, and you like scamper off to Europe. You wouldn't like do that to the East Coast.
I hate the weather in New York. It's one of those maddening things. There's only like 2 months of nice weather, like the fall and a couple of uh, maybe months in the spring. Otherwise, it's either too bitterly cold or too hot and humid. And when it's dirty and smelly, it's just yeah, not great. But you know what? I will say, the 3 months I spent in Europe, this was the longest I've been outside the U.S. since I immigrated. Just absolutely lovely way of living. In between, Sicily and Poland. Greece was more of a, just I mean, I was floating around on the boat, but I feel beyond lucky to have an EU passport, which I will pick up next time I go there next year. And I sense a lot of adventures between me and you that we're in the coming months and years. We could coordinate more of like on the spot. We're next to each other and we go do some fun stuff, because living in Europe, and it was a joy. Such sweet people in Sicily and in Poland, and just can't wait to go back.
Yeah, it's great. Like, give me like a tiny bit more advance notice rather than like, am I going to see you in Warsaw in 2 days' time? And I'm definitely down to come and visit. Yeah, and now I know you're in Warsaw, not just somewhere arbitrary in Poland. Yeah.
Right on.
All right. Well, thank you to our Patreons. And with your Patreonage, we're trying to build and improve the show. So hopefully you're enjoying the trajectory we're on. One day, maybe your Patreonage means that Christoph will be able to quit his professorial job. I don't know what the students of Austin will do then. And
they'll be riots will erupt.
I hope you got a bunch of value out of today's show. It's good to be back. Like, the last 2 episodes were both like interview episodes. And by the way, we had like a whole bunch of topics we had to cut out at the last minute that we're pushing to next week just because there was too much to talk about. But on next week's episode, we're going to revisit Christoph's 10x portfolio from like November. So we're about 9 months in to his 10x portfolio. We're going to check in and see how it's doing and how his conviction has improved or waned on some of his 10x stocks. And I think you've got a new 10x stock you've added to your predictions. So keen to get to that next week.
Yep. We're at patreon.com/Wall Street Wildlife. And we do have the Dolphin channel where we talk about our trades. So that, I hope, is proving valuable.
Are you ready to become a beast of an investor?
Your journey starts here.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.